Hi everybody, my name is Bernicke and I'm going to be doing your monthly market update for April 2024, and I wanted to talk a little bit about the stock market this month as it pertains to how it's going to do going forward in the future, because I find a lot of people right now are a little bit more nervous today, and I think a lot of that has to do with really strong market performance in 2023 and so far in 2024, as measured by the S&P 500 index, we've gotten off to a pretty good start for this year as well. So when you look at the S&P 500 index, one of the things you'll frequently hear people talk about is its price to earnings ratio, or its PE ratio, which is one measuring stick on how overvalued or undervalued the stock market is. Generally speaking, when the PE ratio is really low, as you can see on the left side of this particular graph right here, that generally implies that the stock market will do better on average well into the future. Doesn't always work that way. There's always anomalies to that and exceptions to the rule. But when that PE ratio valuation gets higher, the stock market tends to perform poorer over the long term into the future. And this scatter plot shows exactly that. Again, when you look when the PE ratio is really low, the average rate of return the following 5 years, based on these different scatter plots you see, there's many times where the stock market actually averages over 20% per year over the following 5 years. When the PE ratio on the S&P 500 is quite high, you can see over here that the S&P 500 actually has many times where it performs below zero, and it actually has a negative rate of return on average per year over the following 5 years. And right now, the PE ratio is 21, which is a little bit higher than where it has been historically, which would imply single-digit returns going forward the next 5 years. But I think this might be a little misleading right now, and I'm going to share the reason why I believe that to be the case. If you look at the top 10 biggest companies in the S&P 500 index, they presently make up over 1/3 or 33.5% of the S&P 500 index. And so that would include companies like Nvidia, Microsoft, Google, Facebook. So those real large, high-growth companies, many people would call those tech companies, have gotten so disproportionately large as a percentage of the S&P 500 index. What happens to them tends to influence the S&P 500 a much greater deal than a lot of the other stocks in the S&P 500 index. If you look at those top 10 biggest companies right now, their PE ratios on average is 28.4. That's a very high PE ratio, which isn't a good thing. However, when you look at the remaining 490 stocks in the S&P 500, their PE ratio is 18.3, which is still a little bit above historical norms, but certainly not grossly above historical norms, which would imply more average rates of returns for those remaining 490 stocks. So again, this isn't an exact science. There's always exceptions to the norm, but when you look at the majority of the companies in the S&P 500 index, I would not label them as grossly overvalued. So our advice to our clients right now with stocks is the same advice that Sir William Wallace gave to his army in the movie Braveheart. Hold, hold, hold. I hope you have a great rest of your spring, and we'll be in touch. Thank you.